I know bank share price have dropped and maybe you're concerned. If you see headlines like this, STI drops 1.9% because of US recession fears. Local banks were among the biggest decliners on the benchmark index. If you are panicking, hopefully don't. As an investor, stay patient, stay long term. These are just headlines that exaggerate things, and they assume very often that something in future would definitely happen, but they may or may not come true. So stay calm as always. Instead, I'd like to focus your attention to the fundamentals of Singapore banks. I'll give you a balanced point of view and then I'll address what these headlines really mean. So if you're keen to find out, continue watching. And let's start the ball rolling with OCBC Bank. The headline reads, OCBC Bank has missed estimates with fourth quarter earnings only at $1.69 billion. This is a drop from previous quarter, which was $1.97 billion. Actually, if you move back a bit, you realize that OCBC's performance seems to have been deteriorating even though share price has been climbing. This is very different from UOB and DBS. In this announcement, they've also mentioned a $2.5 billion capital return plan. And how it works is that OCBC will pay shareholders a special dividend for 2024 and 2025. In addition, they'll be doing share buybacks over the next 2 years. I know share buybacks excite many investors, but I'd like to re-highlight again that they should be done when the share price is cheap. Usually not when it's all-time high. As what Warren Buffett has mentioned, when a company overpays for repurchases, the continuing shareholders lose. What it means is because when a company has excess profits, they can A, buy back their own share price at high, or B, give you back the money. You decide whether you want to buy the bank shares or you want to buy something else. So at least you have that choice. But back to OCBC Bank. They have mentioned that they see loan growth slowing in 2025, even though their loans have grown for last year by 8%. I put up this chart to quickly describe to you if you are a shareholder of OCBC. OCBC has the least exposure to Singapore loans across all three banks. If I'm not wrong, DBS has the highest, followed by UOB. UOB is also focused on ASEAN. OCBC also has more exposure to Greater China, which includes Hong Kong, Taiwan, and Macau. But what we can read over here is that net interest income for OCBC seems to have flattened. Quarter on quarter, there is not much growth. And the key part to note is net interest margin has shrunk yet again for fourth quarter 2024. Again, net interest is the core component of a bank's profitability. The key reason why they are record profits is because interest rates have gone up and they've made a lot of money through net interest income. So the question is this slide in net interest margin only to OCBC? When we look to UOB, we would realize that there's also a drop reported over there. Net interest margin has dropped from 2.05 to 2% only. And with that, their net interest income from loans have actually dropped comparing quarter on quarter as I've indicated in the red arrow. But all in all, that did not stop UOB from producing a fourth quarter profit that beat forecasts. UOB's profits have continued rise in 2024, correct? And they've also unveiled a capital return plan. And this is worth 3 billion Sing dollars, bigger than OCBC's. Even though again UOB is smaller than OCBC in market cap. UOB will be paying 50 cents of special dividend and they'll be doing 2 billion worth of share buybacks. I think on a percentage, this is the most aggressive of the three banks. Maybe UOB CEO is optimistic about their bank's operations because he himself has sunk in almost 8 million of his own money to buy 200,000 shares of UOB at $38.65. This will be music to your ears if you're an existing shareholder. At this juncture, let me do a quick shout out to Moomoo SG. If you're looking to buy Singapore bank shares, whether it's OCBC, UOB, or coming up later DBS, you can actually check them out on Moomoo. As a Moomoo user myself, what I love about it is that it has $0 of commissions for Singapore stocks and 30 days commission free for Hong Kong stocks. It really helps keep costs low. Instead of going through lengthy financial reports, Moomoo gives me all the key data I need in one place. For example, revenue breakdown, financial estimates, chart of financial statements, dividend yield, which makes all the analyzing of a stock so much easier. Plus, Moomoo gives free access to analyst rating and Morningstar research so that I can see expert insights and make better investment decisions. Moomoo also has powerful trading tools that you can use also as an investor. You can see their price charts clearly and you can see all the comments and latest news. If you're buying Hong Kong stocks or US stocks, you would need to do currency conversion, correct? And with Moomoo, it's very simple. That's what makes a great trading experience. And with that, if you're new to Moomoo, you can use my sign up links below in the description to get $820 worth of new sign up rewards, including up to $450 worth of Tesla stocks and an exclusive $20 trading cash coupon just with my link. So what are you waiting for? Look for my links below and don't miss out on it. So thank you very much, and let's move on to our third and final bank, who is DBS. DBS has also exceeded expectations, doing a record high $11.29 billion. At the start of 2024, most analysts were forecasting around $10 billion, or at least some stagnation compared to 2023. So 11.29 is really above entire expectations. And one of the key reasons is that originally, Fed rate cuts were projected to be more aggressive. But what we saw for the entire year, looking back, is only 50 basis points of cut. That's why net interest income has stayed high, and this has allowed record profits. So let's look at their outlook for 2025. Up first, they are forecasting net interest income to be slightly above 2024 if there's only 2 rate cuts in second half of this year. Slight decline in net interest margin will be offset by loan growth. And for pre-tax profits for 2025, it is expected to be around 2024's level of $11 billion. However, net profit will be likely below 2024 due to the new global minimum tax of 15%. DBS has already forecasted this, and they've prepared $3 billion worth of capital buybacks, and recently they've announced extra 15 cents per quarter, which is 60 cents for a year, of additional dividends. And just very recently, DBS has announced a 15 cents capital return for the year ahead. And I know all these are very complicated, so let me map them out to show you what exactly you'll be getting if you want to invest in DBS right now. There's still the standard dividend, which I think is reasonable forecast at 60 cents. Again, this is a forecast, and as what we have heard so far, they expect profitability roughly the same. Then, there's this 15 cents that is a capital return, and only for the next 4 quarters. So in total, you'll get 75 cents for 2025. And on top of that, there is a 3 billion share buyback that DBS has not mentioned a fixed time frame yet, and it will be executed over the next few years. Hopefully this share buyback, just as UOBs and OCBCs, is done when prices come down a bit. At least that provides a support to prices, because we don't want them to be executing share buybacks at all-time high. Now let's talk about recession risk headline in this chapter. I'll break down into 2 parts. The first is speculative headlines that US might go into recession. And the second part is somewhere else that might really be faster in this recession risk. So let's start with US first, because US is the biggest economy, correct? I don't know if you've seen this, but Atlanta's Fed has sounded on Trump's session warnings. Atlanta's Fed provides real-time estimates that are historically quite reliable. So as you can see in this chart, there's a sharp drop on the right-hand side, correct? And that has caught markets' attention. Is it that they are seeing slowdown on the ground because of all the tariff nonsense? But again, if this is one of the most reliable, then it must be priced into bank stocks. Some put recession risk for US up now at 35%. Goldman Sachs, they inched it up to 20%. And again, all this is very speculative. And what we need to know is that if recession comes, very likely 2 things will happen. Banks will see a drop in profit margin because rate cut comes in, correct? And the second part is that bad debts tend to increase in recessions, impacting banks' profitability. Goldman Sachs have seen their share price correct very sharply in the last few weeks, and actually their correction actually started earlier in February already. The big question is, if US is in recession, many parts of the world, including Singapore, would also go into recession, correct? And that's why I prepared all this information for you to become more prepared. When bad news hits, you're a lot more steady. When bad news hits, you are more ready to buy than others. And that's actually how we make money on the markets. And as always, if you agree on that, smash the like button and press on subscribe, especially when you get updates on investment ideas and on how to build towards your own retirement. Thank you very much, and I've got further learning points to share with you on where it's really slowing down, which is down under in Australia. Australia bank stocks lose 26 billion on profit margin concerns. This is due to the recent share price drop. And in this chart, you will see that the white line is the Australian Bank Index, and the blue line is the overall Australia ASX 200 Index. And quite clearly, you can see that Australia's banks have contributed 70% of gains for Australia's index. This is very similar to Singapore. But what is not similar is that in Australia, The economy has been weak. One problem has been mining, which is a key sector. It has been slowing down. The other banks are facing more competition, and thus their profit margins have shrunk. In addition, the Central Bank of Australia has recently announced a cut in interest rates, which directly impacts their net interest income moving forward. I brought this up to quickly highlight that we should not get complacent, that there will never be a correction in bank stock prices, even though our Singapore banks have done very well. So if you see opportunities that you'd like to invest in, check out again our sponsor for today, Moomoo SG, who have their sign-up offers. Use my links below, and I'll conclude today's discussion with this previous video I had. Why you always seem to lose money? Seem to, not actually. It's just a sensation of going through market cycles. So if you can find out, watch that, and hopefully it helps you in your investment journey.